The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday, the 12th of December. Jeremy, welcome back. Nearly Christmas time.
Yeah, happy nearly Christmas.
Yes, I haven't quite finished my shopping yet. I don't know about you, but...
No, I put my mum's Christmas tree up yesterday. She said I'd wasted a career doing anything else. She thought the Christmas tree was so lovely.
She obviously not been paying attention to our podcasts, but oh well. Anyway, no, I'm sure your Christmas tree skills are very good, but you're also pretty good at looking at the world macro environment and telling us what's going on. So what's caught your eye this week and what do you think we need to be thinking about?
Well, apart from putting up my mother's Christmas tree, the main event this week was the Fed decision on rates, which has widely been described by Fed watchers as a hawkish cut, which basically means the Fed rate setters aren't sure what to do. Sort of them saying, we'll give it a go this month, but don't think you'll get this in the future. And in response, the market is now signalling that there'll only be one further rate cut in the whole of 2026, down from a previous minimum of at least two. And there are several reasons for this sort of apparently conflicting messaging. First is just the politics, probably the least impactful actually in the short term. As we know, this is likely to be Jay Powell's parting gesture as the incumbent Fed chair. And while his term runs till May, his successor is now expected to be announced in January. And the favourite by a long way is Kevin Hassett, already being dubbed Hassett equals real asset due to the impact that he is already having on the price of precious metals. And he is widely expected to be an Uber dove and do Trump's bidding once he assumes his position.
Okay, so that would be if official rates lower.
Yeah,
right.
And the sort of big move. But I think recently sort of wiser heads have sort of prevailed and the world according to Scott Bessent, and I think, to be fair, Kevin Hassett himself, who, he's got a certain reputation to preserve here of, some standing. This guy's not a Republican stooge, albeit that's how it's been interpreted. And I think the more nuanced view is that this new Fed chair, if it is him, is just not going to come in and just slavishly cut by 100 basis points because Bessent needs to finance his debt. And if he does that, the 10-year rate's just going to go through the roof.
Yes, you can do all you like with the short-term rates, but long-term rates, if people think the inflation genie's out of the bottle, then long-term rates are going through the roof. Yeah, okay.
Yeah. So an increasing number of commentators are now suggesting that Bessent actually has a surprise or even a cunning plan up his sleeve for next year. I mean, how he actually squares this circle, I don't know, but I mean, he's undeniably the adult in the room when it comes to the Trump inner cabinet. And the guy's got a track record of being able to second guess, at least, if not be a step ahead of the market. So I don't think we've sort of seen the end of this. The second reason for the hawkish cut, and the most important in the near term, is the fact that clearly the Fed has a dual mandate of inflation and employment. And on this latter point, it's increasingly occupying the minds of the FOMC members. Despite having impaired labour market data, the data that is there and the anecdotal evidence is that employment prospects are deteriorating at an increasing pace.
Yes.
And in addition to that, sort of the idea advanced when Powell seemed to suggest that inflation was just a function of trade tariffs, which we're soon to be annualizing, the first quarter of next year. And therefore, this sort of inflationary burst that we're seeing, or the inflationary concern we've got at the moment, is, I guess, for want of a better word, transitory. Although, funnily enough, he didn't choose to use that wording in his speech this week. But there's also a third thing going on here. Sorry to labour this point, but the Federal Reserve also has a sort of little mentioned sort of tacit third mandate, which it shares with the wider US government, the US Treasury Department for sure. And that is the preserving of the functioning of the US dollar financial system, which is critical for them and for us. And in this regard, there was a sort of the additional twist in the Fed meeting this week and the announcements around it, where Jay Powell confirmed that not only had the Fed stopped reducing its balance sheet, i.e., it has stopped quantitative tightening, it has taken steps to inject $40 billion into Treasury bill purchases, which to the uninitiated might sound like the start of quantitative easing.
Goodness me. Yeah, okay.
Now, I'm of the view that if something looks like a duck, quacks and waddles, it's usually a duck. And I asked Grok whether what was going on here was in fact quantitative easing, and was told off immediately. And of course it wasn't.
I'm sure Grok's got a good view on these things, but you need to be careful what you ask these US-based AI machines, lest they don't let you into the country in the future. So,
that is a concern.
So it's not quantitative easing, but it does seem that way. It looks a bit like it.
And it is undeniably, at least in the short term, an expansion of the Fed balance sheet. Now, obviously, it's not on the scale or the term or the systemic nature of this sort of balance sheet expansion that we saw in 2020 and 2021. But 4 or 5 years on from that period, we're still suffering the consequences of that event. So it's not surprising that investors and markets are sensitive to what might be going on here.
No, for sure. So I can see why you've got the three different dynamics there in terms of, okay, we had a rate cut this week. The messaging around that is necessarily complicated because, I suppose that the first point is there's a lot of politics around Jay Powell, Kevin Hassett, and however that transition is going to be managed. Secondly, you've got the fact that inflation is still running relatively hot, but the employment market is deteriorating quite quickly. And then thirdly, yes, you've got the broader remit of making sure that the wheels don't fall off. So a bit of quantitative easing at the same time as telling markets that interest rates might not be coming down quite as quickly as they hoped. That's probably a nice little sort of safety net to have.
Yes, I think that's a good way of summarizing it. I mean, then you've got to ask yourself the questions, why are they trying to fix something that doesn't appear to most people to be broken? And that's where I think the similarities come back, not to 2020, but 2019, when we had a thing called the taper tantrum. And the Fed was then caught off guard and had to initiate a similar move to the one we're seeing now, albeit to be fair to them now, it looks like they're preempting a similar sort of dysfunction in the US government repo market and other sort of short-term liquidity plumbing of the global financial system, for which most of us just take for granted. You have to ask yourself, what is going on here? Why are they so concerned about it? And I think if there is a smoking gun out there, it's probably resides in Tokyo. And I've been saying this for a while, and I've been criticized by lots of people who've been following the Japanese market for longer than I have for highlighting this. But I still think this is where things are unraveling a bit, and they're unraveling more slowly than they have done historically. But 10-year JGB yields have gone up sharply recently. The politics in Japan has changed. The geopolitics between Japan and China have changed. And there is clear evidence that Japan is repatriating its capital. And Japan is the largest owner of everybody else's debt. And in a world where the Western world cannot control its indebtedness, this is a problem.
Yeah, I'm sure other people have different views, but actually, if you look at the long-term Japanese rates, they're going through the roof on a relative basis or compared to their local sort of historical norms. And I think, as you made the point, when Scott Bessent was appointed, his first visit was to Tokyo, wasn't it?
Yes.
So, he's very aware of these things. And at the time when it's not entirely clear why the Fed might be moving to a effectively quantitative easing situation, we're looking around for what might be the cause of that. An aggressive or worrying unwind of the carry trade could very well be something that's vexing their minds at the moment. So interesting. Okay.
Their rates have to go up. And the key barometer, I guess, is the differential between US 10-year and Japanese 10-year. Whichever way you look at it, I think a lot of people in financial markets are assuming that gap is going to close. And that's not easy to do. There are consequences of that gap closing.
It must have been, 15, 18 months ago where the carry trade started to unwind rapidly and that got headlines very quickly when that started to be an issue. So if that happens again, then we need to be careful and be watchful. So no, we'll certainly keep an eye on that. Okay. What else is going on in the States? You mentioned there's a bit going on in sort of the large end of the US market.
Yeah, in mega cap land, We've got news of an IPO of SpaceX, reportedly planning a $1.5 trillion, that's trillion with a T, IPO next year. So, yeah, good to get some IPO fees on the back of that one. That's all lined up. And it's been a busy week for the Ellison family, with Larry's Oracle being, I think, one of the key tests for the AI infrastructure trade. Oracle's role as a bellwether for these hyperscale data center spending, that's obviously a key part of whether we're in an AI bubble or not. And the Oracle results were poorly received because they highlighted the cost and the financing issues that this build out represents. And everyone's trying to identify who the bag holders are going to be in the event that this thing starts to slow down or, heaven forbid, unravel. The Oracle shares took a bit of a hit.
Okay.
But it was also a busy week for Larry Ellison's son, who's involved in Paramount's $108 billion hostile bid for Warner Brothers.
Of course, yeah.
So some cynics have suggested that the reason that the Oracle share price was, shall we say, pumped up a little bit earlier this year was in order to help finance the Ellison family involvement in Paramount. But needless to say, Larry has got some well-connected friends in the Middle East and in the near Trump family, people such as Jared Kushner. And they've all got together and decided that they wanted to buy Warner Brothers for $108 billion. So I thought I'd do a quick check to see whether this was the largest hostile bid ever. So, yeah, had to ask Grok again. And it's not the largest. It's certainly on an inflation-adjusted basis. This is not the largest. Okay. But there's two that are bigger from some time ago now. One was Vodafone's bid for Mannesmann in 2000, and the other was RBS's bid for ABN AMRO in 2007, of course.
Okay.
There's no precedence there, nothing to see here. Everything's fine.
That's fine. So, yes, time will tell. Yeah. Yes. Okay. Yeah. But yes, you're right. Having some friendly characters in the White House to help ease the regulatory path might be quite useful for the Ellison family.
Indeed.
See what happens. Interesting. Okay. And what about next week? What's coming up data-wise?
Tuesday, we've got UK unemployment data, which is be above the 5% level reported last month. We've also got some UK PMI data, give us some sort of directional trends for the services and for manufacturing sectors, which I suspect sort of pretty stagnant around the 50 level.
Is it possible we start to get some positive sentiment post the budget, or is it too soon for that to show through, perhaps? I don't know.
I think that might be a bit early.
Okay. Wait till the new year for that.
Yeah. And from the US on Tuesday, we're going to get some delayed non-farm payroll data, according to my sources, both for October and for November. So on that basis, next week is subject to a dose of double jeopardy. But just looking back, December 2024, the US economy added 323,000 new jobs. And the figure expected for October 2025 is for 55,000 new jobs. So just gives you a colour on the extent to which the US employment market is slowing down. These data points, individual data points, are very volatile. So any statistician will say that's not representative of the broader trend, but the trend is down.
Yeah, sure. And going back to the point you made at the beginning about the Fed and the challenges they've got in terms of managing inflation against this rapidly cooling jobs market, you can see why they're a bit confused about what to do. Makes sense. But maybe next week we'll give them and us a bit more information.
Yeah. The other things to bear in mind are the events in Venezuela, which seem to be taking a few new twists and turns, and then what happens in Europe with the peace plans for Ukraine, where there does seem to be a bit of movement on the Ukrainian side, and the asset sequestration process that's sort of going along in tandem with that, which I think will have direct implications for financial markets.
Yeah, lots to look at there. Many of the things impacting potentially the oil price, which obviously Trump's trying to get down by allowing the free flow of oil from these currently embattled areas, and whether the EU helps or hinders it in terms of the asset theft, as the Russians would say, of these Russian monies. We'll wait and see. Yeah, lots to look forward to. We're going to talk, I think, once more before Christmas.
Yeah.
So we'll catch up this time next week and see how everything's going.
Okay. Speak then.
Talk to you then. Thanks.
Brought to you by Progressive Equity.